hard money.
It just has a certain ring to it, doesn't it?
It really does. I have to be honest, when I first saw this was our topic for today's deep dive, my mind did not go to, legitimate finance.
Oh, where did it go?
Straight to a noir film. I'm talking like a rainy Chicago alleyway, maybe 1940s. There's a guy in a trench coat, fedora pulled down low.
A cigarette, definitely.
Oh, absolutely. A cigarette dangling from his lip. And there's a suitcase full of cash non-sequential bills, of course being slid across a wet table.
That is a remarkably vivid picture and a very common reaction.
It just sounds so intense, maybe a little illegal. If I'm asking for hard money, it feels like I've run out of all other options.
Like you've burned every other bridge in town.
Exactly. It sounds like the kind of money that comes with a very specific, very physical repayment plan if you miss a payment.
You're talking about broken kneecaps.
I didn't want to say it, but yeah, my imaginary version of this definitely involves kneecaps being at risk.
Well, I can assure you and everyone listening that we are not here to discuss organized crime or loan sharking today.
Okay, good.
While the name is gritty and, frankly, the industry knows it as a massive branding problem, what we're actually talking about is a legitimate, pretty sophisticated, and an absolutely critical corner of the financial world, especially in North America.
So it's a real financial instrument.
It's a financing instrument that keeps a huge, huge portion of the real estate market moving.
So I should probably put the trench coat away.
I would put the trench coat away. But keep the skepticism, because this is a world that operates on a completely different set of rules than your local neighborhood bank.
That's what I want to dig into.
Yeah.
Because looking at our research stack here, and we've got a lot, from trade group resolutions to, federal regulatory history, it feels like a parallel universe to traditional banking.
That's a perfect way to put it. For a long time, it was basically a shadow banking system.
So what's our mission today, then? We've got to decode this whole world. If it's not illegal, why the scary name? And the big, for me, the thing that just jumped off the page.
Let me guess. The interest rates.
The interest rates. Why are smart, rational business people willing to pay double-digit interest rates for this money?
That's the central mystery, isn't it? Why pay 12, 13, 14% interest when a bank is charging, 7% right now?
Right.
We're going to unravel that. We're going to get into the mechanics of risk and collateral. But I think the most fascinating piece of this puzzle is how the global financial crisis of 2009,
the big one,
the big crash, inadvertently poured gasoline on this entire industry.
I love when we can trace things back to 08, 09. It really does feel like the big bang of modern finance. Every time we peel back a layer on the economy, there's a route that goes right back to the housing bubble or Dodd-Frank.
It completely reshaped the plumbing of the global financial system. And hard money is one of the things that grew very quickly out of the rubble.
Okay, so let's set the vibe for everyone listening. If we're not in that rainy back alley, where are we? What's the scene?
Okay. I want you to imagine you're a real estate investor, not a homeowner looking for a place to raise a family. You're a business person. You're driving down a street in your city and you see that house.
Oh, we all know that house.
You know the one. The grass is 3 feet tall. There's plywood over a couple of windows. Maybe a big tree limb has crashed through the porch roof and nobody's moved it for 6 months.
It's an eyesore. The neighbors hate it.
The city has probably slapped a condemnation notice on the front door. It's the zombie house.
The zombie house, exactly.
Now, most people, they just drive past that and they see a disaster, a problem. But you, the investor, you stop. You look at the bones of the house, the structure. You know the neighborhood's getting better. Prices are going up.
You see potential.
You see potential. And you do some quick math in your head. You think, okay, if I could buy this wreck for, say, $100,000 and I put $50,000 of work into it, I bet I could sell it for $250,000.
Okay, I'm with you. That's a $100,000 profit margin just sitting there rotting away.
It's a gold mine disguised as a total dump. But here's your problem. You need the cash now.
Why now?
Maybe it's a foreclosure auction that's happening on Friday. Or maybe the owner is just desperate and they say, look, the first person who shows up with a certified check gets the keys.
So, okay, simple. I go to my bank.
Right.
I walk into the branch with the free lollipops and the pens chained to the counter. I sit down with the loan officer and I say, hi, I found a fantastic deal. I need $100,000 by Friday to buy a house with a giant hole in the roof.
And what do you think that loan officer does?
They laugh at me.
They look at you, they look at the picture of the house with the hole in the roof, and they very politely ask security to show you the door.
They won't touch it.
No way.
Yeah.
Traditional banks, they generally cannot lend on properties that are considered uninhabitable. They have these strict checklists. The roof has to work. The plumbing has to be functional. And even if the house was in perfect condition,
They're slow.
they move at the speed of a glacier. You're looking at 45, maybe 60 days to get a loan approved.
And by that time, the deal is long gone.
Someone else bought it for cash a month and a half ago. So you're stuck. You found this guaranteed profit, but you can't access the capital to actually unlock it.
And that is the moment hard money walks in the door.
That is exactly where our story begins.
All right, let's unpack this. We have to start with the definition because I think hard money is one of those terms people just throw around. What makes the money hard? Is it hard to get? Hard to pay back?
That's a really common misconception. People hear hard and they immediately think difficult. But in this context, hard actually refers to the hard asset.
Okay. The physical thing, the property.
Exactly. It is a very specific type of asset-based lending. And to really get it, you have to compare it to how a normal loan works. Think about when you got a mortgage for your house, or even just a credit card. What did the bank want from you?
Oh, everything. They wanted my pay stubs, my W-2s, my tax returns for the last 2 years. They ran my credit score. They probably called my boss to make sure I still had a job.
Right. They were underwriting you. They were looking at your soft data, your character, your reliability, your income stream. The bank is betting on the person. They want to be sure that you personally are good for the money.
Which makes sense. They want to get paid back.
Of course. But in a hard money loan, the lender is primarily, sometimes almost exclusively looking at the thing.
The house.
The hard asset, the real property. So the borrower gets funds that are secured by that property. The hard asset is the ultimate backstop for the whole deal.
So they don't really care about me, my credit score and all that.
They care a little bit. They want to know you're not a known fraudster or something. But they care mostly about the building. Their internal logic is basically this. I don't really care if this borrower lost their job last month. I don't really care if their credit score is a 600. What I care about is, if they stop paying me, can I take this house, sell it, and get all my money back plus profit?
So the building itself is the co-signer on the loan.
Mm-hmm.
The bricks and mortar are doing all the heavy lifting in the approval process.
That is a perfect way to put it. It is collateral-centric lending. But, and this is the key, because the lender is relying so heavily on the asset and often ignoring those soft metrics like a perfect credit score, the whole risk profile changes.
And because the risk is higher.
The terms have to look very, very different.
And this is where we get to the numbers that make people's eyes pop.
Mm-hmm.
I really want to talk about the cost of this money.
It is not cheap, that's for sure.
The sources we have mention interest rates starting around, 8 or 9% on the absolute low end, but much more commonly sitting at 12, 13, even 14% or higher.
Yes, double-digit interest is the norm in this industry.
And then there are points on top of that.
Yes, points, which are basically origination fees. Usually, a hard money lender will charge anywhere from 2 to 4 points right up front, and 1 point is just 1% of the loan amount.
Okay, so if I'm borrowing $100,000, I might have to pay $3,000 or $4,000 right out of the gate just to open the loan.
Correct, before you've even made your first interest payment.
Wow. So you've got the 14% interest.
Plus legal fees. Plus processing fees, appraisal fees.
This sounds, honestly, it sounds extortionate. If I'm a business owner, why would I ever agree to this? It really sounds like I'm being taken advantage of.
It does sound that way, but only if you're comparing it to, say, a 30-year home mortgage. You have to remember the duration of these loans.
Right, you're not taking out a hard money loan for 30 years.
No, God, no, you'd be bankrupt. These are incredibly short-term. We are talking 6 months, 12 months, maybe 24 months on the long end.
It's a sprint.
It is a sprint. It's designed to be a bridge. You get in, you use the money to fix the property, you sell it, or you refinance into a cheaper long-term loan, and you get out. You pay that hard money loan off as fast as humanly possible.
So you're not actually paying 14% interest for a decade. You're paying it for maybe 6 or 8 months while you do the work.
Exactly. You have to think of it as a convenience fee for getting access to that capital so quickly when no one else would give it to you.
That's a good frame. Now, I noticed something interesting in the research about the geography of all this. The sources mention that this term hard money and this whole style of lending, it's almost exclusively a North American thing.
It is, yeah. You find it almost exclusively in the United States and Canada.
Why is that? Why don't they have hard money lenders in London or Paris or Tokyo?
There are private lenders everywhere in the world, of course, but this specific systematized industry of hard money for real estate flipping and distressed assets is very much a product of the U.S. and Canadian legal and economic ecosystem.
And it comes down to the laws.
It comes down to foreclosure law, really. In the U.S., generally speaking, if you don't pay your mortgage, the lender has a relatively clear, defined, and most importantly, fast legal path to take that property back and sell it to get their money.
So our system is pretty lender-friendly.
It's relatively lender-friendly, yes. In a lot of European countries, for example, tenant protections and borrower protections are much, much stronger. It can take years, I mean, literally years, to foreclose on a property.
Ah, I see. So if I'm a lender in, say, France, I can't really lend based on the hard asset because I might never actually be able to get my hands on it if the borrower defaults.
You've got it. If your collateral is going to be locked up in legal purgatory for 5 years, your entire asset-based model just completely falls apart. The liquidity of the U.S. real estate market is what allows this industry to even exist.
It has a very, I don't know, cowboy capitalism feel to it. Like, I need money to build this saloon. Here's the deed to my land. Now give me the cash.
There is a bit of that frontier spirit to it, for sure. It's all about speed and opportunity, and it's completely separate from the slow, bureaucratic machinery of traditional banking.
Okay, so we know what it is. It's asset-based, it's expensive, it's short-term. But I want to circle back to the why. We use the zombie house example, but let's really drill down on the borrower's motivation, because paying 14% interest plus points still stings.
It does sting, but let's look at the alternative. If you have that zombie house deal, the one with the guaranteed $100,000 profit margin, and you can't get the money from a bank, what's your profit?
It's zero. I lose the deal.
Right. So the choice isn't between a cheap loan and an expensive loan. The choice is between an expensive loan and no loan at all. So would you rather have 100% of zero, or would you rather pay a lender, say, $15,000 in interest and fees and walk away with $85,000 in your pocket?
When you put it like that, it's a no-brainer.
It's just a cost of doing business. For an investor, it's a line item on a spreadsheet. It's like buying lumber or drywall. You don't complain that lumber costs money, you just need it to build the house. Hard money is just another raw material.
So the two main drivers seem to be speed and flexibility. Let's talk about speed first. How much faster are we really talking here?
We touched on it, but it's worth hammering home. A typical bank loan is going to take you 45 to 60 days, best case scenario.
Right.
A hard money loan can fund in 7 to 10 days. I've seen them close in 48 hours.
That is lightning fast.
It's unbelievable. And in a competitive real estate market, that speed is currency. If you're bidding against 5 other investors for that same property, being able to go to the seller and say, I can close in 1 week all cash, because hard money is treated as cash, that often gets you a discount on the purchase price.
Oh, that's a great point. So the speed itself can actually save you money on the acquisition.
Very often, yes. You might end up paying 14% interest, but you got the house for $10,000 less than the other guy because you could close in a week. It all balances out in the end.
Okay, and then there's flexibility. This is the documentation part you mentioned.
Right. The dreaded checklist. Banks live and die by the checklist. And if you're self-employed, if you have irregular income, if you're a freelancer, if your income comes from 10 different projects, banks hate you.
I feel that on a personal level.
A lot of people do. You could be making fantastic money, but if it doesn't show up neatly on a W-2 form from a single employer every 2 weeks, the bank's algorithm just sees you as a huge risk.
So how are hard money lenders different?
They're often private individuals or small local funds. They can use common sense. They can sit across a table from you and say, okay, I see your tax return is a mess, but I also see you have a ton of cash in the bank, and this house you found is a grand slam deal. Let's do it.
There's no corporate headquarters in New York City telling them no.
Exactly. They can underwrite the story of the deal, not just the borrower's FICO score.
Now, I want to clarify something here, because the research brings up bridge loans constantly. And it feels like people use these terms, hard money and bridge loan, interchangeably. Are they the same thing?
They are cousins, very close cousins, maybe even siblings. They share a ton of DNA. A hard money loan is very similar to a bridge loan in terms of the lending criteria and the costs to the borrower.
Are both short-term, asset-based, higher interest.
Correct. But there is a bit of a nuance, a vibe shift, if you will.
A vibe shift.
Yeah. A bridge loan usually sounds a bit more polished, a little more corporate. It often refers to a commercial property or an investment property that's just in a state of transition.
Okay, give me an example of that.
Let's say you buy a small apartment building. It's in decent shape, but it's only 50% full because the last owner was lazy and didn't market the empty units.
Right.
A regular bank won't give you a standard commercial loan on that building because the income isn't high enough yet. It doesn't cash flow properly.
So you're stuck. You need a bridge.
You get a bridge loan for 12 or 18 months. You use that money to do some light renovations on the empty units. You hire a leasing agent. You get the building to 95% occupancy. Now the building is stabilized and making great money.
And then you go to the bank.
Then you go to a regular bank, you get a cheap 30-year loan, and you use that to pay off the expensive bridge loan. You've successfully bridged the gap from instability to stability.
Okay, that makes perfect sense. Bridge loans are for properties in transition.
Yeah.
So what makes hard money different? What's its vibe?
The distress factor. Hard money, as a term, often implies a situation that is a little more dire, a little grittier.
Okay, here comes the drama.
This is where we get into the historical roots of the industry. Hard money isn't just an asset-based loan for a simple transition. It often involves a distressed financial situation.
Like what?
Like being in arrears on an existing mortgage.
So the borrower is already behind on their payments to another bank.
Exactly. Or they're in the middle of bankruptcy proceedings. Or, most commonly, they are facing active foreclosure proceedings.
Wow. Okay, so if I'm in foreclosure, a traditional bank won't touch me with the 50-foot pole. They will run in the other direction.
A traditional bank sees a foreclosure notice and they see a 4-alarm fire. A hard money lender sees a foreclosure notice and they see equity.
Explain that. How do they see equity in a disaster?
Okay, let's say you own a building that's worth $1 million, but you fell on hard times, lost a big client, whatever. You owe the bank $400,000 on your mortgage, and you haven't been able to make a payment in 6 months. The bank is about to foreclose and auction it off on the courthouse steps. You're about to lose everything.
A nightmare scenario.
Right. A hard money lender looks at that exact same situation and says, wait a minute. You owe the bank $400,000, but the building is worth $1 million. There is $600,000 of equity trapped in that property.
That's real tangible value.
It's real money. So the hard money lender comes to you and says, look, I will lend you $450,000. We'll use $400,000 to pay off the bank immediately and stop the foreclosure. You'll have $50,000 left over to make some repairs, clean the place up, and sell it properly on the open market.
So they act as a lifeline.
A very, very expensive lifeline. But yes, the industry really developed historically as exactly that, a lender of last resort for property owners who needed to access their equity when all the traditional doors were slammed in their face.
So if I'm hearing this right, the hard money lender's pitch is basically, I see you're in a tough spot, but I also see you have a valuable asset. I'll give you the cash you need, but the deal is, if you don't pay me back on my terms, I'm taking that asset.
That is the fundamental trade-off. And that brings us perfectly to the mechanics of how they protect themselves. Because if your business model is lending to people in bankruptcy or in foreclosure or to flippers who are taking on risky gut renovations, how do you make sure you don't lose your shirt every other deal?
Right. If the borrower is inherently risky, the lender must have a massive safety net built in.
They do. And it's a 3-letter acronym, LTV, the loan-to-value ratio. This is the golden ratio, the holy grail of the hard money world.
Okay, let's break down LTV. It sounds like something from a math class, but I have a feeling this is where the rubber really meets the road on these deals.
It's the only number that truly matters in the end. And the formula is super simple. It's just the loan amount divided by the value of the property.
Simple enough.
But here is the kicker. A traditional bank on a primary residence might lend you 80, 90, sometimes even 95% of a home's value.
Right, I just have to put down 5 or 10% and the bank covers the entire rest of it.
In the hard money world, that never, ever happens. There is no such thing as 100% LTV or even 90%. Most hard money lenders will cap their LTV at around 65% of the property's current value.
65. That's a massive buffer.
It is an enormous cushion. And it's completely intentional. If a property is worth $100,000 today, the absolute most a hard money lender will give you is $65,000.
So where does the other $35,000 come from for the purchase?
That comes from you. That's the borrower's contribution. You have to have significant skin in the game.
Skin in the game.
These loans are for professional investors, and the lenders will always require a much higher down payment or for you to already have a lot of existing equity. They want to know that if you decide to just walk away from the project, you are leaving a big chunk of your own money on the table.
That makes a lot of sense. It keeps the borrower motivated to actually see the project through to the end. If I have $35,000 of my own cash tied up in a deal, I'm not going to just disappear.
You're going to answer your phone when the lender calls. But it also protects the lender in the absolute worst case scenario.
Which is foreclosure.
Right. So let's say you default on that loan. The lender has to take the house back. Now they own a house that's worth $100,000, but they only have a $65,000 loan on it. Even if the real estate market suddenly crashes and the value of that house drops to $80,000.
They can still sell it for $80,000, pay off their $65,000 loan, and still walk away with a profit after covering legal fees.
Exactly. That low LTV is designed to absorb market volatility, holding costs, and the legal expenses of a foreclosure. It's a huge margin of safety.
Now, this brings up a really technical but important point that came up in the listener feedback and the research. Value is a subjective thing. If I'm flipping a house, there are really two values, aren't there? There's what the house is worth now in its dumpy condition and what it's going to be worth after I fix it up.
Yes. And that is the critical distinction between the as-is value and the ARV, which stands for after repair value.
This seems absolutely crucial. Which one of those values do they lend on?
It really depends on the specific lender and the deal, but this is where the industry has gotten a lot more sophisticated over the years. Many of the best hard money lenders will actually lend based on the ARV, the future value.
Wait a minute. That sounds incredibly risky. They're lending you money based on a value that doesn't even exist yet.
It sounds risky, but they control the process very, very carefully. Let's go back to our zombie house example. Purchase price is $100. The renovation budget is $50. The future value, the ARV, is $250K.
Got it.
A lender might come in and say, okay, our rule is we'll lend you 70% of the ARV. So 70% of $250,000 is $175,000.
Wow. Okay. That's enough to cover the entire purchase price and the renovation costs.
It is. But, and this is a very, very big but, they do not just hand you a check for $175,000 and say, good luck, hope you actually fix the house.
So what do they do? How do they manage that?
They'll give you the money to buy the house, so the $100,000, but they hold the renovation money, the other $75,000 in this case, in a separate escrow account. And they only release it to you in stages, which are called draws.
Draws?
Yes. So you go out and you fix the roof. Then you call the lender. The lender sends an inspector to the property to verify that, yes, a new roof has been installed and the work is done correctly. Then they release the money to you for the roof. Then you do the kitchen. They inspect. They pay you for the kitchen.
I see. So they're drip-feeding you the renovation money to ensure that the value is actually being added to the property step by step.
Precisely. They are managing their risk throughout the entire construction process. Their LTV is always protected because the loan amount never gets too far ahead of the actual current value of the house.
That is incredibly structured. It's so much more than just, here's a bag of cash, see you in 6 months.
Oh, no. It is a very, very tightly managed process. And speaking of value, they're also very specific about how they determine it in the first place. They don't just take your word that the house will be worth $250,000.
Right. The notes mention something called liquidation value. That sounds ominous again.
It sounds ominous, but it's just realistic. They aren't interested in what the property might sell for in a perfect market with 6 months of marketing, professional staging, and, fresh-baked cookies in the oven for every showing.
They're interested in the fire sale price.
They're interested in what they can sell it for quickly if things go horribly wrong and they have to take it back.
So how do they figure out that number? It can't just be a guess.
No, it's all data-driven. They use a few common methods. One is a BPO, which is a broker price opinion.
What's that?
It's kind of like an appraisal light. They pay a local real estate agent a small fee to drive by the property, look at the condition, pull some recent comparable sales in the neighborhood, and give a quick professional opinion of what it would sell for.
And that's faster than a full appraisal, I assume.
Much faster and cheaper. A full appraisal can take weeks. A BPO can be done in 48 hours. Again, speed is the name of the game. Or, for a more complex deal, they'll order a full independent appraisal done by a licensed appraiser in that state. But the instruction is always, give me the value for a quick sale, 30 to 60 days on market.
So we have the mechanics down. It's a low LTV, high interest, short-term loan, often with escrowed renovation funds. It's a machine.
It's a machine designed to monetize risk in a very specific way.
But where did this machine even come from? Was there like a specific moment in history where someone woke up and said, I'm going to start a hard money lending company?
We can trace the origins of the modern industry back to the late 1950s.
The 50s. That seems counterintuitive. I always think of the 50s as this golden age of traditional banking. You get a free toaster when you open a savings account.
It was, but the credit industry in the U.S. was also undergoing some really drastic changes. As the post-war economy boomed and real estate development took off, there was this huge demand for capital that the traditional, very conservative banks just weren't meeting.
The last resort option that we talked about earlier.
Exactly. It really started out as private, wealthy individuals, doctors, lawyers, successful business owners, lending their own excess cash to local developers they knew. It was very informal. A lot of handshake deals.
The guys in the trench coats.
Maybe not trench coats, but definitely guys at the country club and in cigar bars. But if we fast forward to today, the industry is having a bit of an identity crisis.
An identity crisis. How so?
Well, remember how we started this whole deep dive saying hard money sounds like something out of a crime film?
Yeah, the broken kneecaps.
Well, the industry has finally realized that too, and they really don't like it.
They want a makeover.
They want a full rebrand. The consensus in the industry over the last few years is that the term hard money just doesn't accurately describe the direction, the structure, or the attitude of the profession anymore. It sounds rough, it sounds predatory, it sounds unsophisticated.
So what do they want to be called instead? Soft money? Fluffy money?
Laughs. Not quite. In March of 2022, the National Private Lenders Association, the MPLA, they passed an official resolution.
An official resolution. That sounds very serious, like something the UN would do.
It was very serious for them. The resolution encouraged all industry participants to completely drop the term hard money.
And replace it with what?
They suggested alternatives like private lending, bridge lending, or, my personal favorite, transitional lending.
Transitional lending.
Yeah.
That sounds so much more professional. Very corporate. It sounds like something you'd discuss in a glass conference room, not a back alley.
It does. And the other big trade group, the American Association of Private Lenders, the AAPL.
Not the phone company.
No, not the phone company. They published this big article called The Demise of Hard Money in a Private Lending World. Their entire 2021 national conference was basically focused on this exact terminology shift.
It's fascinating, isn't it? They're trying to gentrify the name of their own industry.
That's a great way to put it. As the industry has matured, institutional capital, we're talking Wall Street money, hedge funds, pension funds, has started pouring into the space.
Yeah.
And you can't go to a pension funds board and pitch them on investing in a hard money fund. It just sounds too risky.
But if you pitch them on a private credit fund or a transitional asset-based lending strategy.
Now that sounds like a smart, sophisticated portfolio diversification.
But here's the real question. Does changing the name actually change the reality of the deal?
No, not at all.
It's still 14% interest, right?
In most cases, yes.
It's still a 65% LTV.
Yes.
And it's still ultimately based on the liquidation value of the asset if the borrower defaults.
Absolutely. You can put a new, fancier wrapper on the candy bar, but the candy inside is exactly the same. It is high cost, high risk, asset-based capital.
So speaking of the rules of this game, how regulated is this industry? Is it the Wild West, or are there sheriffs watching over it?
It's a mix, but generally speaking, the field has always been formally unregulated by state or federal laws in terms of its general operation.
Formally unregulated. That's one of those phrases that always makes me a little nervous.
Right. It means there isn't a federal hard money commission that's overseeing every single deal. A private lender doesn't have the same kind of direct oversight as, say, Bank of America.
But that doesn't mean there are no rules.
Not at all. The biggest catch, the biggest regulation they all have to follow is usury laws.
Usury laws, that's a term you don't hear every day. That's like biblical.
It is. It's an old concept, but it basically just means that there are legal limits on how much interest a lender can charge on a loan. And these limits are set by state governments.
So a lender can't just decide to charge 50% interest because they feel like it.
In most states, no. And this creates this really interesting patchwork landscape across the country. For example, the sources we looked at mention that lending operations in states like Tennessee and Arkansas are described as virtually untenable for these firms.
Really? Why those states specifically?
It all comes down to the math of their state usury laws. In Arkansas, for example, the maximum interest rate you can charge is tied to the federal discount rate plus a certain percentage, often 5%.
Okay.
So if the federal rate is really low, the legal maximum interest rate in Arkansas might be capped at, say, 10 or 11%.
But the whole business model for hard money requires them to charge 12, 13, 14% to cover their risk and make a profit.
You've got it. If the state law says you can only charge 10%, but your business model requires 13% to even break even, you simply cannot do business in that state. You have to close up shop and go elsewhere.
So there are literally hard money deserts in the United States, places where you can't get these loans,
Yeah.
purely because of old state laws.
Yes. The geography of the industry is heavily dictated by these old interest rate laws. But the biggest shift, the one event that truly caused this industry to explode in modern times, wasn't a state law. It was the direct aftermath of the 2009 mortgage crisis.
And there it is, the aha
Uh,
moment of the episode. It always comes back to 2009.
It has to, because the hard money or private lending mortgage market has expanded exponentially since the passing of the Dodd-Frank Act.
Okay, Dodd-Frank, we hear that name all the time. It was the massive piece of legislation that was the government's big response to the banks crashing the economy.
Right. And its main goal was to stop banks from ever making those kinds of terrible loans again. Part of that response was a major update to the Truth in Lending Act, or TILA.
Sounds Dunley enough. Truth in lending.
It introduced a very powerful new rule called the Ability to Repay Rule, or ATR.
Ability to repay.
Yeah.
That just sounds like basic common sense. You shouldn't lend money to people who can't possibly pay it back.
In theory, yes, it's common sense. But in practice, it meant that mortgage originators were now legally required to rigorously evaluate and document a borrower's ability to repay a loan, specifically on primary residences. They have to document income, assets, employment, every little detail.
No more Anangia loans, no income, no job, no assets.
Those were gone overnight. And here is the real kicker. Under Dodd-Frank, if a bank makes you a loan and you default, and it turns out they didn't document your income perfectly according to the new rules, the bank can face enormous federal fines. The borrower can even sue the bank to stop the foreclosure.
So the banks got scared.
They got absolutely petrified. Overnight, they stopped lending to anyone who didn't fit into a perfect, easy-to-document box. If you were self-employed, suddenly you were too risky. If your income was irregular or commission-based, too risky. If you were a real estate investor with a complicated tax return showing lots of deductions, the bank just said no. It wasn't worth the potential legal risk of a federal fine.
And that created a vacuum.
A massive gaping vacuum. Suddenly, millions of people, legitimate business people, investors, entrepreneurs with good credit and real assets, found themselves completely locked out of the traditional banking system.
And the hard money lenders stepped in to fill that void.
They did. But, and this is the most crucial part of the modern industry, they did it by avoiding the primary residence market entirely.
How did they do that?
They made a very strategic shift to focus specifically on business purpose or commercial loans.
Okay, explain the difference. Why did that matter?
Dodd-Frank and TILA and all those ability to repay rules are designed to protect consumers. They exist to protect the family buying a house to live in.
Okay, that makes sense.
But if you are if you're an LLC buying a house specifically to renovate and flip for a profit, you are considered a commercial entity. You are a sophisticated borrower. The government basically assumes you're a professional and you know what you're doing.
So those strict ability to repay rules don't apply to business loans.
They do not apply. As a business borrower, you don't get those same consumer protections.
And that means the lenders don't have the same restrictions or legal risks.
Exactly. By sticking strictly to business and commercial loans, the private lenders completely avoid the risk of falling under those strict Dodd-Frank, TILA, and HOPIA guidelines. It created this very clear dividing line in the market. The big banks handle the slow, document-heavy, highly regulated residential mortgages for homeowners. And the hard money lenders handle the fast, flexible, asset-based commercial and investment projects.
This is truly fascinating. So if I were to call a hard money lender today about a property, will they actually ask me if I plan to live in the house?
That will be one of the very first questions out of their mouth. And if you say, yes, this is for me and my family to live in, they will hang up the phone.
Really? Just like that?
Or they will very politely refer you to a traditional mortgage broker. They literally cannot and will not lend on owner-occupied homes because the compliance costs and legal risks are just far too high. They stay strictly in that business purpose lane.
So, in a strange way, the very regulation that was designed to make the banking system safer for consumers actually triggered the massive boom in this alternative, high-interest, largely unregulated lending market.
It is the classic law of unintended consequences. When you squeeze the balloon in one place, in this case, traditional banking, all the air just rushes to another part of the balloon, in this case, private lending. The demand for that capital never went away. It just had to move to a different provider who was willing to supply it.
That's a perfect way to look at it. So let's just zoom out for a second. We have covered a ton of ground here today.
We really have.
We've defined what this stuff is. It's an asset-based loan secured by real estate. And the hard refers to the property, the hard asset, not the difficulty level.
Correct. Collateral is king.
We've looked at how they manage their risk. That 65% LTV cap is really the shield that protects the entire industry. They never lend the full value of the property, so the borrower always has significant skin in the game.
Always. That's non-negotiable.
Then we walk through the history, all the way from the informal 1950s origins to this modern branding crisis, where they are desperately trying to get everyone to stop saying hard money and start saying private lending.
Right, the gentrification of the name.
And finally, we saw how the 2009 financial crisis and the Dodd-Frank Act essentially carved out the perfect modern niche for this industry by pushing the big banks out of the messy but profitable lending space.
It's a really fascinating ecosystem. It's this parallel financial system that operates right alongside the banks we all see on every street corner, but it plays by a completely different set of rules.
It seems like it's a vital part of the economy, too.
It's absolutely vital. Think about every house-flipping show you've ever seen on TV. Think about that new apartment complex in your city that used to be an old, rundown warehouse.
Yeah.
Think about that zombie house in your own neighborhood that finally got fixed up and sold to a young family.
The one we talked about at the beginning.
Exactly. The chances are extremely high that a traditional bank did not fund that renovation. Private money did. Hard money did.
That's a fantastic point. This industry is what fuels the renovation and revitalization projects that the big banks are now too risk-averse to touch.
Exactly. It provides essential liquidity to a segment of the market that would otherwise just freeze up and decay. Without this source of capital, millions of distressed or transitional properties would just sit there rotting because no one could get the cash to fix them.
So for you, listening at home or in your car, why should you care about this? Maybe you're not planning on flipping houses. Maybe you're just a regular person with a regular job.
Well, for one, whether you're an aspiring real estate flipper or maybe someone who's just looking for alternative places to invest your own money, because remember, you can also be the hard money lender.
Wait, I can be the lender. I can be the one charging 13%.
Absolutely. Many of these private lending funds raise their capital from individual accredited investors. You can put your money into a fund and they lend it out on these deals at 12 or 14%, and they pay you a return of 8 or 9%. It's a way to participate in the real estate market without ever having to swing a hammer.
That is a whole other deep dive for another day.
It is. But even if you never invest a dime, this is important because it explains how so much of the world around you actually gets built and rebuilt. It explains how projects get funded when the obvious answer from the bank is no. It explains the mechanics of risk and reward in their absolute rawest form.
It's the engine of the alternative economy.
It really is.
So I want to leave everyone listening with one final thought to chew on. We talked a lot about the rebranding effort. The industry is trying so hard to be called private lending or transitional lending. It sounds softer, it sounds nicer, more professional.
It definitely does.
But does a softer name really change the hard reality of the transaction? At the end of the day, the entire model still relies on the liquidation value of your asset if you fail.
That is the provocateur's question, isn't it? You can call it transitional lending, you can call it boutique capital solutions, but if you don't perform, the underlying mechanism is exactly the same. They are coming for the asset. The collateral is and always will be the king.
It's something to think about. The next time you're stopped at a red light and you see one of those yellow corrugated plastic signs stapled to a telephone pole that just says, "We buy houses for cash." There is a whole world of these hard money mechanics grinding away right behind that simple little sign.
Indeed there is.
Thanks for diving in with us on this.
My pleasure. It was great.
And we'll see you on the next deep dive.